Good afternoon. I'm Jim Kokolas with Calibre CPA Group. Thank you for joining us today and welcome to our 2022 Employee Benefit Plan Virtual Conference. Our speakers from Calibre and our featured guest speaker, Tom DeMayo, principal of PKF O'Connor Davies, will share their insights and provide key information critical to enhancing the regulatory compliance and efficiencies of your employee benefit plans. So before we jump into the presentations, let's just take a moment to let you know how the conference will flow today. We will have a Q&A session after the conference, so please go ahead and type in any questions that you might have in the Q&A window on your screen there at the bottom. And we'll answer as many of the questions as possible at the end. For those that are interested in obtaining CPE or continuing professional education during today's session, you'll be prompted with various polling questions throughout the conference in order to comply with the CPE credit requirements. So please make sure to answer those as they pop up throughout the conference today. Also for the CPE, you'll receive an email with instructions on accessing the program materials, requesting up to 2.5 hours of CPE credits. So let's go ahead and welcome our first speaker today. Mary Margaret Prange is an audit partner at Calibre CPA Group and will be sharing auditing and accounting updates. Mary Margaret has significant audit experience with employee benefit plans. She's a regular presenter for educational seminars, conferences, and client events, and has also developed and taught a number of courses on auditing and accounting, as well as a multitude of other programs. So welcome, Mary Margaret.
Thank you so much, Jim. Good afternoon, everybody. It's nice to be here with you. So we're going to be talking about accounting standards updates, and then once we finish those topics, we'll switch over to some auditing standards updates. Always one of the most interesting topics of these seminars. So, and as you can see, our first topic here, leases. Yes, we're still talking about leases. With COVID, we got the opportunity to kind of kick that down the road one more year. So I'll just spend some time kind of going through that because it's upon us at this point. I've got some information about some accounting standards updates that came out in 2020. Nothing really that's super applicable to the employee benefit plan world. So I'll just kind of touch on a few things just in case some of you also work on nonprofit organizations, 501c5s, or 501c3 related entities. They may be applicable to you. And that'll be the same thing with the 2021 standards. Great news. Prior to 2022, FASB was super busy coming out with a ton of standards for us to kind of dive into, take a look at, see how they're going to impact our practice and the work that you do on a daily basis. But in 2022, not much has come out. They've actually only issued 4 standards, and I'm not going to even cover them because none of them are applicable to any of the work that we do. So let's jump back into leases. So as I mentioned before, we got the opportunity to kind of push this out one more year, which gave us a little bit more time to kind of wrap our arms around it and get comfortable with what's going to be happening to our financial statements coming up related to this new standard. So this is going to be applicable to financial statements ending December 31st, 2022, and then fiscal years ending starting in 2023. As we remember, this standard came out, it was targeted to improve financial reporting regarding leasing transactions and will affect nonprofit organizations and also employee benefit plans that lease assets. So we're talking about property and equipment, office space, things like that. Now for the employee benefit plans, I think the concept of materiality is going to come into play as far as whether you actually have anything to record with this. But really good for us just to dive in to kind of take a look at how this is going to impact. So it's going to require lessees to recognize on your balance sheet or your statement of financial position or the statement of net assets available for benefits, an asset and a liability for the right to use the leased property and an obligation that's created by that lease. So prior to ASU 2016-02, so what's currently required under GAAP, we had to determine whether the lease was considered capital or operating. And there was a 4-pronged test to do that. On the capital leases, when the lease met that, you were required to recognize liability on the balance sheet. After implementation of ASU 2016-02, you are going to be recognizing a right of use asset and a lease liability for virtually all leases that are over a 12-month term. The liability is going to be equal to the present value of the lease payments, and the asset will be based on the liability. And we're going to talk a little bit more specifics about that as well. But that asset will also be subject to adjustment for any initial direct cost. So for the lessee, after implementation of ASU 2016-02 on the income statement, leases are going to be required to be classified as either operating or finance. So there is a 5-prong test for that, and I have a slide on that, so we'll walk through that in a little bit. What you're going to see when we get to it is that it's very similar to the test for capital leases that we're used to kind of taking a look at when we look at these leases. But for the capital leases, we really only did that. It really was only applicable to things that weren't the space that you were leasing. But the space you're leasing is going to meet the definition of having this asset and this liability now. It's most likely going to be an operating lease. It won't be a finance lease, but it's still going to indicate that you're going to have a right of use asset and the lease liability. Under the operating leases, this is going to result in more of a straight line expense that's similar to your current operating lease. So no major impact on the income statement related here. And then the finance lease is going to result in a front-loaded expense pattern, and that's very similar to the current capital leases. There are some new disclosure requirements related to this, and I have a slide, and we'll kind of dive into those in just a few minutes. With respect to the lessor, not really much has changed with regard to implementing ASU 2016-02. Nothing is really substantially different in this arena, so I'm not going to really talk about that too much. As far as the disclosure requirements, this is everything pretty much that's required. Some of this was already required, so not going to touch on all of it. I think one of the more important items here is the third bullet point. You're going to need to disclose the existence, the terms and conditions of options to extend or terminate the lease. And that is actually going to factor into the overall calculation of the right of use asset and the lease liability. That's pretty much all that's going to be different. I mean, the disclosures are going to look a little bit different, but essentially all of the same elements are going to be there as before. In addition, some information about the leases that haven't yet begun but have already been signed. So you're going to need to include some information about that. In addition to that, you're going to have some information about any significant judgments or assumptions that were made in accounting for the leases, specifically talking about determining whether the organization is reasonably thought to take advantage of any options to extend the lease, or whether you think the lessor might decide not to provide the option to extend the lease. So you'll have to disclose some information about that, but also the determination of the discount rate. Now, subsequent to this ASU actually coming out, there was another ASU that came out that gave nonprofit organizations and also employee benefit plans the option to use the risk-free discount rate. And I have another slide that's going to dive into that a little bit more, but essentially it's going to be a little easier than we thought when this ASU first came out to determine what that discount rate is going to be. Few more disclosure requirements, the main terms and conditions of any sale leaseback transactions, and then if you are utilizing an accounting policy election for the short-term leases, if they are under 12 months, you need to indicate that in the footnotes that you're taking advantage of that election so that you don't have to do the calculation for those leases. So here's kind of something to kind of follow to kind of walk you through what to do when you're looking at your leases. Do you actually even have a lease? What is the term of the lease? What is the discount rate? And are there any non-lease components that need to be taken into account when you're determining the calculation? So when you're looking at whether you actually have a lease, FASB and GAAP now define a lease as the right to control the use of an identified asset for a period of time in exchange for consideration. But what does control really mean? So control is defined as the right to an economic benefit or the right to direct use of an asset. So determining the right to direct use of an asset might require a little bit of judgment. So in that case, you're probably going to have some additional disclosures related to that. Really where I think this is going to come into play for most of the organizations that we work with, and specifically employee benefit plans and labor unions, is going to be your leases for space, for the unions, any leases for cars, phones, and copiers, and things like that. So that's really where this is going to be the calculations that you're working on. Determining the lease term. So the term is defined in generally accepted accounting principles now as the non-cancelable period for which the lessee has the right to use the asset, plus periods covered by these three things. So the option to extend if the lessee is reasonably certain to exercise that option, the option to terminate if the lessee is reasonably certain not to exercise the option, and then the renewals or extensions of the lease at the option of the lessor. So you got to take all of that into account when you're coming up with the actual term of the lease. And again, there's an exception to the general rule if you have any leases that are 12 months or less. So determining the discount rate. Initially, what the ASU said is that you have to use the rate that's implicit in the lease if the rate that causes the present value of the new investment in the lease to equal the sum of the fair value of the assets minus the related investment tax credit and the capitalized initial direct cost incurred by the lessor. But most of the leases that we see in our practice, there isn't a rate that's really implicit in the lease. So then you could use, the guidance said that you could use the incremental borrowing rate. Well, employee benefit plans and a lot of not-for-profit organizations don't really have an incremental borrowing rate. So then there was another ASU that came out that gave the option to use this risk-free discount rate. And what we're going to see later is that there was another ASU that came out that kind of dove into that risk-free discount rate and how it can be used. So I'll cover that in a little bit. This has just been a lot of different things coming down the line as questions were coming up during implementation from other organizations. So are there any non-lease components? What does this really mean? They have to be accounted for separately, but this is going to be like for an equipment lease that also includes maintenance services. So those are going to need to kind of be carved out of the calculation and expensed as they normally would be. That would be the same thing if you had had a financing lease or an operating lease before. So that really hasn't changed that much. So this is just a diagram of kind of how you determine what the initial lease liability is going to be, and then how you add to that or subtract to that to come up with that initial right of use asset, which is going to be the asset on the balance sheet. So the initial lease liability is going to be equal to the present value of the lease payments due over the lease term, taking into account any options that are reasonably thought to be taking on extending the lease or options that you're not going to take. Again, utilizing some judgment there. Once you have that initial lease liability calculated, you are going to be able to calculate the initial right of use asset. And that's going to also include any lease payments that were made before the lease commencement happened, any initial direct costs, and then what's going to come out of it is any lease incentives that were received from the lessor. They're going to be accounted for similarly to how they were accounted for before. So one thing I do have to share with you is we do have a really nice spreadsheet that we've put together. It's actually several spreadsheets in an Excel workbook where you can plug in all of the data elements from the lease, and it's going to be able to do a lookup of what the risk-free rate was at the time of the lease and that the lease commenced. And then it's going to do the calculations for you of the initial lease liability as well as the initial right of use asset. So we can share that with you when the time comes that you're ready to kind of take a look at that. Well, my slides are not advancing. Okay, so here is the 5-prong test to determine whether you've got either an operating lease or a financing lease. And what you'll notice, if you can remember back to when you were studying capital leases way a long time ago. That was a 4-prong test. This one is 5, but a lot of this looks very similar. So the first part of the test is, does the lease transfer ownership of the underlying asset to the lessee by the end of the term of the lease? So if that's the case, then you have a financing lease. Does the lease grant the lessee the option to purchase the underlying asset that the lessee is reasonably certain to exercise? If so, then you've got a financing lease. Is the lease term the major part of the remaining economic life of the underlying asset? Now, what we saw when we were looking at finance leases is there was a percentage that was used. There's no longer a percentage, so you really have to use your own judgment here. And then the fourth one is the present value of the sum of the lease payments and any residual value equals or exceeds substantially all of the fair value of the underlying asset. If you remember back, there was a percentage that was used when you were trying to determine if you had a capital lease. It was 90%. Again, no percentage anymore. It comes down to judgment. And then finally, this fifth part, it says, does the underlying asset is of such a specialized nature and would have no alternative use at the end of the lease term, then you have definitely got a finance lease. So that you have to walk through that test on any of your leases to make sure you are accounting for it correctly as either an operating lease or a finance lease. During the transition, there are a couple of practical expedients that you can use. You do not need to reassess whether any expired or existing contracts are or contain any leases, so you can kind of take that off the plate. You do not have to reassess any lease classifications for any expired or existing leases. And then you do not have to reassess the initial direct cost for any existing leases. You also may use hindsight in determining the lease term, so that can be part of your judgment process. So what you can be working on now is taking an inventory of all your existing lease contracts. And we've been reporting this for several years now. So hopefully you have already started that process, because this is really coming up soon for a lot of folks. Assess the implementation challenges and options, and then also estimate any impact the implementation will have on financial statements, key ratios, metrics, and things like that as applicable to your organization. Okay, so that's all we're going to do for leases, and we've got one of our first polls up. Just wanted to see if anybody had implemented the new leasing standard yet. All right, so walking us from 2016 over to 2020, there were about 11 different accounting standard updates that came out back in 2020. Good news, not a lot of them were had any real significance to nonprofit organizations or employee benefit plans. The one that's kind of in bold here at the bottom was some COVID relief that kind of came out of FASB during 2020. Essentially, the revenue recognition that had already been implemented by for-profit organizations, but needed to be implemented by not-for-profit organizations, was supposed to be done in calendar year 20 and fiscal years ending in 2021. They gave a 1-year deferral of that if the organization wanted to take advantage of it. And then, but most didn't. But the leases, most people did defer the 1 year. So again, that's coming due for calendar year 2022, and then for fiscal years ending in 2023. The only clients I really had that took advantage, or I wouldn't even say advantage, but went ahead and implemented the lease standard were clients that were getting into new leases. They just didn't want to have to do the straight line lease calculation and then go back in a year and do this new calculation, which is just a little bit different. So the only other one that I was going to talk just a little bit about is for those of you that are on with us today that also work on nonprofit organizations, specifically probably 501c3 charity type organizations. ASU 2020-07 is related to contributed non-financial assets that come into not-for-profit organizations. It's effective as of, for the first time, June 30th, 2022 financial statement dates. So the objective of this ASU was to kind of increase the transparency about contributed non-financial assets through enhancements and presentation and disclosure, basically just providing a little bit more information. Before this accounting standard update came out, you could group the contributed non-financial assets with other contributions, and there just weren't as many disclosures, and the disclosures that were being included in financial statements were kind of not uniform between organizations, and they wanted to make sure that they were more uniform. So what is a non-financial asset? It's fixed assets such as land, buildings, or equipment, the use of fixed assets or utilities, materials and supplies, intangible assets, services, and unconditional promises of those assets. So just kind of moving us forward, since this is not really applicable to EBPs, but I just wanted you to have the information. Again, present these now, you're required to, in a separate line in your statement of activities. And then in the disclosures, you are now required to disaggregate the amount of the contributed non-financial assets by the category. And then there's going to be some additional disclosures that are required related to each of the different categories. So this is just some information on how GAAP used to be, but I really want to just to kind of give you an example illustration, and I have two of them. So this is one where there is a separate line. This is one type of presentation after implementation of ASU 2020-07, and you can see the contributions, they're broken out between cash and other financial assets, and then in kind, you can see they're broken out there. And then just a slightly different presentation is they've got a separate column that they're using to put all of the in-kind information in, and then everything else is in the other, and then they're showing the total there. So that's how the statement of activities will look. Here is an example of what you would need to include in the footnotes, the disclosure illustration here, and you can see how that number is disaggregated by the type of contributed non-financial asset. And then this is an example of if you can either provide the additional information in the footnotes kind of in a paragraph form for each of the different categories, and that's what I've got included here, or what I think is a little bit easier to digest is this table that you could include in the financial statements, where you've said, you know, what the different category is, the revenue that's recognized, and then how it's utilized in programs and activities, whether there's any donor restrictions, and then the valuation techniques and inputs that were used to determine what the revenue was that was recognized. And that's really it for that. For 2021, there were 10 ASUs that came out in 2021. Again, not really many that were applicable specifically to employee benefit plans, but just I highlighted this ASU 2021-03, which relates to intangibles, goodwill, and other, and it specifically dives into an accounting alternative for evaluating triggering events that might impair goodwill that has been recognized. So this is an alternative that not-for-profits can use. And then, so we'll take just a quick look at that. And then 2021-09, this relates to the discount rate. So this was after some, questions and things that had come up during implementation of the new leasing standard. FASB came out and gave a little bit of help and assistance on when to use the risk-free discount rate and how it can be used. So we'll talk a little bit about that. And then 2021-10, not applicable at all to nonprofits or employee benefit plans. So don't really need to talk about that at all. I just included it there and highlighted it because some of the nonprofits had taken advantage of some of the government assistance from the COVID, but that was carved out of that ASU. So with respect, and I'm not going to spend too much time on this, but to the goodwill and intangibles, this extends to private company alternatives to nonprofit organizations. They can amortize the goodwill over 10 years or less. but more specifically kind of these last two bullet points, but you can test the goodwill for impairment at the end of the reporting period. Prior to that, you were having to test it upon a triggering event, which was cumbersome and really just a lot more additional work that had to be done. So they were trying to kind of streamline this a little bit. And then organizations do have the option to do the impairment test at the entity level instead of at a reporting unit level. So that's really the main thing there. On 2021-09, with respect to the leases, this gave the option to allow entities that are taking advantage of the risk-free rate to do the election by class of asset that's being leased rather than doing it at the entity-wide level. So when the rate implicit in the lease is readily determinable for any individual lease, the lessee must use that rate rather than a risk-free rate or an incremental borrowing rate, regardless of whether it has made the risk-free rate election. So that is something that they clarified in ASU 2021-09. All right, so that takes us to the end of the accounting standards. So now we're going to move on to the new auditing standards. And a lot of you probably already seen this, but I just wanted to kind of go through this and make sure you had a good understanding of it. There's going to be some information that we don't cover in the presentation today, just with respect to some new auditing standards, but I thought you might want to take a look at it, just if inquiring minds want to know. So first, we're going to talk about some auditing standards that came out in 2019. We've got our second polling question regarding in-kind gifts. And once we talk about the SASs that were issued back in 2019, those are the most significant ones. We'll talk about, there's just some information that's going to be available for you related to the ones that were issued in 2020 and 2021. So one of the ones that came out that was a relief for us is that these new auditing standards that had a major impact on the way the audit opinion looks, and some of the different things that we have to do with respect to our documentation. There was some COVID relief that came out from the AICPA through SAS 141 that gave a year delay for us if the firm wanted to take advantage of it. So most firms did, we did. So that's SAS 141. But kind of flipping back to what came out in 2019. So this came out in May of 2019, SAS 134. So this is auditor reporting and amendments, including amendments addressing disclosures in the audit of the financial statements. This was going to be applicable to all of the organizations, nonprofit organizations, except for employee benefit plans. There actually was a separate SAS specific to audits of employee benefit plans. So again, we took advantage of the COVID relief that was provided. But essentially, what this new auditing standard was trying to do was to conform the reports that are coming out of under generally accepted auditing standards from the US to what's required under PCAOB and international auditing standards, which is just a project that has been going on for quite some time. But essentially the significant changes on the auditor's report, and you may have noticed this already if you've seen the audit reports that have come out for a year ended December 31st, 2021, the opinion is now first. It used to be at the very end of the report. It's now first and then followed by a basis for opinion. After that, included in that basis of opinion is some new language that states that the auditor has to be independent of the organization that's being audited and must also meet the auditor's other ethical responsibilities. All of that was always required. It's just now included in the audit report, saying that if the organization requested any key audit matters to be audited during the course of our financial statement audit, there would be a separate paragraph that was talking about that. I don't foresee that that would really be the case in any of the work that we're doing. And then on the management responsibilities, expanded to include a paragraph that talks about the organization being responsible for making sure that they don't have any going concerns issues going out for the next year. And then that is also included under the auditor's responsibilities, taking a look at whether the organization, from our perspective, can continue to go on for the next year. And then also that there is required communication that is supposed to happen with those charged with governance. All of that was already, being done. It's just now being included in the actual report. So specifically with respect to the going concern, management is responsible to evaluate whether there are any conditions or events that raise substantial doubt about the organization, and that language is included in the report now. And then specifically with respect to communication with those charged with governance, you will see this wording used in our engagement letter and a lot of our planning communication. We are required to communicate with those charged with governance about the significant risks that we've identified related to the financial statement audit. We've always been required to determine what the significant risks are, but now we're required to document that in writing to you. So that probably has been some new language that you've seen. So what I've done here is provided an example of what the report looks like now. So this is the opinion, and remember that paragraph is kind of coming first. So we're indicating what's been audited, and then also what our ultimate opinion is on that information. No changes into the types of opinions that we can provide. You can have still the unmodified opinion, which is the clean opinion. You can have modifications to the opinion, which is going to include a qualification or an adverse opinion if the opinion is not good, or a disclaimer of opinion if there was some kind of information that we just material enough and pervasive enough that we weren't able to audit. After the opinion is going to be the basis of opinion, and just an example so you can see here the additional sentence that's included that says we are required to be independent of the organization and to meet our other ethical responsibilities in accordance with relevant ethical requirements relating to our audits. Again, this was always required and has always been documented by us, but is now included in the actual language of the report, just to be more clear to readers of the report. With respect to the responsibilities of management, this first paragraph is information that has been in the previous report. It's the second paragraph that's really new, and that's talking about whether the organization has any issues kind of going out for the next year, if there's any substantial doubt about its ability to kind of continue as a going concern. There already was a requirement for organizations to make sure that they thought and kind of communicate to us whether they think they can continue into the next year, but now that's just included in the opinion. And then under our responsibilities as the auditor, what you're going to see is this new sentence right here in the middle of this paragraph that really gives the reader an understanding of what reasonable assurance is. When we're issuing an audit opinion on financial statements, that's the highest level of assurance that we can provide. It is not absolute assurance, it is reasonable assurance, because we're not looking at every single transaction. But reasonable assurance is a high level of assurance, but it's not absolute assurance, and therefore is not a guarantee that an audit conducted in accordance with generally accepted auditing standards will always detect a material misstatement when it exists. And then it goes on to say that the risk of not detecting a material misstatement resulting from fraud is higher than one resulting from an error, because fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. So just a little bit more information that the reader reading through the audit opinion can really understand on, kind of what to expect as the ultimate outcome of the audit. In addition, we felt like we needed a little bit more responsibilities than management. So there's a lot of things listed here, but obviously we're exercising professional judgment and maintaining professional skepticism through our audit. That's new language in the report, but that was always the case as we were performing our work. Additionally, we have the paragraph here about our analysis of the going concern and the organization's ability to continue for a reasonable period of time. That's always had to occur, but now it's included in the report. And then what's also new is that we are required to communicate with those charged with governance regarding plan scope and timing of the audit, significant audit findings, and then certain internal control related matters that we identified during the audit. We've always been required to communicate that in writing. It's just now that's included in the actual audit opinion. So SAS 135, this has to do with communicating with those charged with governance relating to specific things that might have come up during the course of the audit. So this is just trying to enhance audit quality and what we do actually end up communicating with those charged with governance. So things that we might be communicating now that maybe we may not have communicated in the past would be any material kind of related party and relationships and transactions with related parties. They may have been disclosed in the financial statements, but they might now be included in what we refer to as kind of our AUC 260 letter. Also, any significant unusual transactions, maybe there might have been a material merger or something like that that we bring attention to in that letter as well. Any matters that we felt were difficult or contentious or for which the auditor consulted an outside engagement team, and then any uncorrected misstatements or matters underlying those uncorrected misstatements that could potentially cause even future period financial statements to be materially misstated, even if we determine that the uncorrected misstatements are immaterial to the financial statements that are actually under audit right now. So you might see some enhanced disclosures in that, not disclosures, communication in that 260 letter. So with respect to SAS 136, this is going to be the one that is specifically related to financial statement audits of an employee benefit plan that is subject to ERISA. So it was required for the year ended December 31st, 2021 and going forward. What you're going to see is it's actually fairly similar to what we saw in SAS 134. But the reason why it was kind of carved out is because employee benefit plans are kind of a unique type of organization, and they wanted to make sure there was some specific things covered with respect to that. So what you may have seen is some added communication in the engagement letter, in the audit report, the management representation letter. It's going to include language regarding the plan's understanding of their responsibility for the plan, the administration of the plan, and all of the disclosures that need to be kind of included in the footnotes to the financial statement. So the plan needs to be maintaining a current plan instrument, including all of the recent amendments, and the plan is responsible for administering the plan and determining that the plan's transactions are in conformity with that plan instrument, including the amendments. With respect to the audit risk assessment and our responses to those identified risks, we have to have procedures for gaining an understanding sufficient to perform the risk assessment that we're doing on the plan before we get started on the actual work. And really the only way that we can do that is if we have the most current plan instrument, including all of the effective amendments. So we now have to document in our work papers what specifically from the plan instrument we've decided that we are testing. It doesn't say that we have to do that, but there isn't really any way to perform an audit on these ERISA employee benefit plans if you aren't actually testing some of the relevant plan provisions. So that is something that we are documenting in all of our audits now. With respect to the evaluation and reporting, if there are any prohibited party and interest transactions or any non-compliance with internal control deficiencies, we've got to have communication with those charged with governance. It's got to be in writing. It's got to be done timely. It can be included in the AUC 260 letter and or the AUC 265 letter, like kind of the management recommendation letter. The communication has to include a description of the reportable finding. There needs to be sufficient information to enable governance and plan management to really understand the context. And there's got to be an explanation of the potential effect on the financial statements or to the plan itself. So some of you might be aware that there was a type of audit that we used to refer to as the limited scope audit. It is no longer referred to as a limited scope audit. It's referred to as an ERISA Section 103A3C audit. And it is still permissible but the plan has to have an investment certification prepared and qualified by a qualified institution. It is no longer really considered a scope limitation. So this under SAS 136, we're forming an opinion on the ERISA plan financial statements. That includes the contents and form of the auditor's opinion on such statements and the auditor's responsibility. So we also have been asking for more information related to the Form 5500. So they wanted to make sure that there weren't any material inconsistencies between the audited financial statements and the Form 5500. So we have some responsibility for kind of looking at those and preparing those at the same time. So as I mentioned, still we have the same type of audit opinions if you're doing what we used to refer to as a full scope audit. So not using the 103A3C election, you can have an unmodified opinion or you can have modified opinions, either qualified, adverse, or disclaimer. And then with respect to the 103A3C report, formerly that limited scope, again, it's no longer a scope limitation. And you're just going to have a modified ERISA section 103A3C opinion, qualified, adverse, or disclaimer. The structure is going to be fairly similar to what we saw under SAS 134. The opinion is going to now include a statement that the plan is an employee benefit plan subject to ERISA. Management's responsibilities are going to include that additional paragraph expanding on responsibilities for an employee benefit plan. And what that means is maintaining the plan instrument and administering the plan. And then the other matters clarify that the information is required by the Department of Labor and that the form and content was evaluated, and also includes a new form and content opinion. And so this, I've just got an example of what the actual audit opinion looks like. You can see similar to SAS 134. The only thing that's really different here is that we specifically said that this is an employee benefit plan and it's subject to ERISA. The basis for the opinion says that we are required to be independent and to meet other ethical responsibilities. You can see there's 3 paragraphs under the responsibilities for management. First one being the same as it was before, the second one being about the going concern, and then finally the third one talking about maintaining the current plan instrument and all of the amendments and administering the plan in accordance with it, and making sure that the plan is able to pay participants their benefits due according to the plan's documents. The auditor's responsibility and gives this additional information on what exactly reasonable assurance is, and that the risk is different for fraud than one resulting from error. Additionally, talking through the fact that we have to exercise professional judgment and maintain professional skepticism, and then conclude whether in our judgment there are any issues with respect to going concern, and that we are required to communicate with those charged with governance, certain things at the conclusion of the audit. And then this is the supplemental schedules that are required by ERISA. The first paragraph looking similarly to the way it used to, but now it includes these 2 other sentences that basically say that we are opining on the form and the content of those schedules. So I think I've actually run out of time. But you're going to have this information when the slides are sent out to you. But this is just, if you want to read it, I mean, it's really more applicable to the work that we do, but it'll give you some more information about some of the things that we're responsible for kind of documenting now. It talks about special purpose frameworks, financial statement standards, reporting on interim information for an audit, the adequacy of audit evidence, and the fact that AI is coming into play with respect to that, and making sure that what you're looking at on technology does not contradict what you're hearing from the organization when they're talking to you about the plan. Some other information about accounting estimates and utilizing pricing from outside experts, and then additional documentation that we have to do for assessing risks for the audit. So there could be some additional questions that kind of come from us as we're implementing those new standards. So our third poll, and then I'll turn it back over to Jim to get us over to the next presenter. Thank you so much.
Great. Thank you very much, Mary Margaret. It's a lot of valuable information. Just to remind everyone, please feel free to send in any questions you may have using the Q&A feature at the bottom of your screen. So our next presenter is Jeff Lewis, a tax partner, CPA, and certified fraud examiner at Calibre CPA Group. He'll be discussing the latest tax updates. Jeff specializes in providing tax services for labor organizations, all types of Taft-Hartley benefit plans, as well as the firm's commercial clients. So welcome, Jeff.
Thank you, Jim. So I'm still waiting for the slides, but welcome everyone to the 2022 Employee Benefit Plan Conference and the annual tax update. The good news, the last couple of years have been significant changes, obviously, in all parts of the employee benefit plan world and everywhere else, just in COVID response. But from a tax perspective, it's really been very difficult, just trying to keep up with all these new tax laws that have come up and making sure that we're compliant in administering them and putting them on the tax return. 2022 and really kind of what's on the horizon, it's a little bit of a different story. It's a little bit quieter. There's not as much activity from Congress as it relates to the new tax laws. But I did want to go through, there is one that was just signed in August that on the surface probably doesn't have a whole lot of applicability to the employee benefit plan world. It's really more geared towards alternative energy credits and really large corporations. However, there was a big part of that is the funding with the IRS, which I think is going to trickle down into really every type of organization. And it's really going to put, I think, a different priority on the regulation and compliance of the tax laws. One of the main aims is to really close the tax gap, which the tax gap is essentially the difference between what a true tax liability is and what the reporting tax liability is. So that's what their aim is. There's a lot of increased funding that's going to the IRS. They actually just issued a notice yesterday where they're trying to tap into those funds that are coming to them. So these are all things that kind of give me pause and just make sure that we're compliant and our clients are compliant in all tax matters. The Inflation Reduction Act is the act that was signed by President Biden back in August, and I'll go into a little bit of detail on that. The second part I want to go over is just kind of some legislation that's on the horizon. These are bills that either the House has passed or the Senate has passed. Right now, there's not really a reconciliation between the two, but there are some tax aspects that are consistent in both versions, mostly pertaining to some RMD restrictions that we currently have, relief from penalty. The third part I want to go through is just the enhanced, and this ties into the Inflation Reduction Act, is more of this move to this enhanced focus on regulation and compliance, whether it's at the federal level or in the state level. And really at the state level, we've seen it over the last couple of years. And the last two sections there are two common types of returns that may not be on everybody's radar, but this is where I fear a lot of this additional scrutiny on regulation is gonna really kind of focus on, and we'll go into a little bit of detail on some of the main ones that we see. Okay, so the Inflation Reduction Act, this is a very, very brief summary. And to be honest, the fourth and fifth bullet point probably aren't applicable in the EBP world. But it was signed into law on August 16th, 2022. And it does seek to mitigate this tax gap. And like I mentioned earlier, tax gap is what's being reported on all these tax filings and what the true tax liability is through maybe failure of compliance on filing additional forms or other types of deductions and things like that. the Congressional Budget Office did estimate that even with this $80 billion going to the IRS over the next 10 years, they are estimating it's going to generate in excess of $200 billion in additional gross revenue. Well, the $200 billion in additional gross revenue, nothing in there was on tax rate changes or additional tax on different types of revenue. It's essentially just trying to make sure that what every entity is filing, they're filing the correct forms, they're paying the right amount, and they're reporting the right amount on those forms. So that's where all this revenue is going to come from, at least in their estimation, which means that from my perspective, and we're already starting to see this with some of our clients, that there has been an uptick in audits from the IRS, notices from the states, more inquiries about whether or not they have any nexus concerns, meaning financial relationships with those states, but this is all in an effort to generate revenue. This next slide is just what I was mentioning earlier, some of the legislation that's on the horizon. Like I said, it has been relatively quiet from a tax perspective. There has been this big push on these alternative energy credits, which again, not applicable here. But just to kind of highlight this Secure Act 2.0, which is in reference to the Secure Act that was passed last year. It was passed by the House and it's kind of still waiting for the reconciliation by the Senate, which they have their own version of this. But the big part of this is Congress is very concerned that individuals just are not financially prepared for retirement. So how can they help in that? And then there's a lot more obviously than these three issues, but they are trying to, the RMD used to be 70.5, it got moved up to 72. Part of the Secure Act 2.0 is to move that to 73 in the next couple of years and 74 and 75 in subsequent years, allowing individuals to work longer and to keep and not have to touch their retirement assets. Also, part of that is this penalty for failure to comply with these RMD requirements, which can be very excessive. They're trying to decrease those penalties, so it's not as penalizing to the individual and their retirement assets. And then there's also an additional catch-up contribution that they're proposing once you get over the age of 60, and then to get more assets into your retirement accounts. And also this potential for Roth, which is after-tax treatment. But again, none of this is in law right now. These are just ideas that both parts of Congress are. I think there's a lot of commonality that this is an issue. And so this is probably something that hopefully they'll be able to reconcile relatively soon. Okay, so this idea of this enhanced focus on compliance and regulation. We've seen this, and to be honest, we've seen it mostly with the states in the past years. A lot of the states were trying to generate revenue, and there were a lot of inquiries about nexus requirements, whether or not, and in the employee benefit plan world, a lot of times you'll see it with alternative investments. Are they, and especially if it's generating UBIT, do they have a 990T filing? In what states are they actually doing the business that's generating that? Some states are obviously much more aggressive than others, but we have seen a lot of these compliance audit inquiries at the state level. With the Inflation Reduction Act and with all of these additional IRS auditors, I can't imagine that that's not going to increase substantially in the near future. So what common filings are that we see, especially related to employee benefit plans? What type of filings are we seeing that may not be obvious? We all know about the 5500s or the 990s in our world. 990T, some entities obviously do have that. But even within the 990T filings, there are some foreign filings that are part of those 990T filings that I think easily get overlooked. and they're not something that's very common, but if an employee benefit plan has a sizable portfolio of alternative investments, limited partnerships, a lot of those limited partnerships are investing in foreign companies. And that's where IRS Form 926, it's a return by a U.S. transfer of property to a foreign corporation. So and there is a threshold. It's $100,000 during the course of the year. If through the partnership, in excess of $100,000 has been transferred to a foreign corporation, there is a 926 filing requirement. And it's not a tax return, it's an information return. So there's no tax associated with that transaction, but it's something that's very important to know that it exists. And one of the reasons why this is often overlooked, or potentially overlooked, is there's no direct reporting that goes from the partnership to the IRS. There's a matching concept with, if you think of just your individual tax return or some of the other commercial tax returns, where information is reported directly on your behalf to the IRS. It goes into their system. When you file your tax return, there's a matching concept. So they'll know if something's omitted. These are not directly reported to the IRS. And in all honesty, a lot of times, the communication to you is through a K-1 filing that you receive with your partnership interest, and it's not even on the front of the K-1. It's in what we call the white pages or the disclosures later on. And so there's a lot of relevant or potential relevant information that's included in those disclosures. And if you kind of gloss through that and just took the information that's on the front of the K-1, put the dollar amount on a 990T, and you were subject to a 926 filing, the penalties can be significant. It's obvious it's not based on a tax, but it is based on the limit is based on the fair market value of that property that's transferred. And there is a limit to the total penalty, but we're talking the penalties are usually going to be in the 5 figures at a minimum. There is a cap to $100,000. So this is something that is very important, that at least it's on the radar when you're going through a K-1. Usually it is a specific disclosure where it will say IRS Form 926 information, and it will give you the name of the entity, the dollar amount, the date of the transaction. The one issue is that this is a cumulative. So if you're an employee benefit plan that has multiple or a sizable portfolio of alternative investments, it could be that you have multiple partnership interests that are actually investing in or transferring assets into the same corporation. So even though maybe you don't meet the threshold from investment 1, in combination with investment 2, you could exceed that threshold. And then the other one below there, sorry, is the 5471. This is a much less frequent filing that we see, especially with K-1s. And this has more to do with the voting power and the control of that foreign corporation, and less to do with the actual financial transactions between a U.S. entity and the foreign corporation. Another issue, there is a poll, and I'll give everyone a little bit of time to look at that. And just real quick, while you guys are looking at that, the international filings that are associated that we discuss here, like I said, there's not a matching, automatic matching with an IRS database. So they're just by not filing the 926, there's no automatic catch. Where this potential risk exists is going to be on direct examination. And when the IRS gets $80 billion and they're going to hire 80,000 new IRS agents, I honestly think that this is going to be an area that they focus, because they really haven't focused on it. It's been more you file and they accept that. And I haven't seen too many audits on the 990T filing by itself. but under direct examination, that's where a failure to file the 926 or the 5471 would really come to light. And the next area is unclaimed property. So this has nothing to do with the federal level. This is going to be more on the state level. And the unclaimed property usually, so the reporting is for an organization to report the property to the state. So then the state can reach out and use their contacts to reach out to the intended user or recipient of that unclaimed property. We have seen, especially in DC, we have seen some correspondence last year and the year before where some of these states have what's called a negative reporting requirement. So even if you don't have anything that would justify the definition of unclaimed property, they actually require a report that says, we've looked at our organization, we've looked at our transactions, we've looked at our outstanding checks, and nothing, and we're certifying that nothing does meet the unclaimed property definition that needs to be reported. So this is an area that I'm, especially with the EBP and also just the audit, in the audit process, that's something to keep an eye out for, is when you do have your bank reconciliations, whether it's a pension check or whether it's just a check to a third party provider of any kind, to see how long it's been uncashed, and see if you do have a responsibility to file this directly with the state. And also to understand that some of these state and the state laws are different depending on what state it is. But in DC, to know that there is a negative reporting requirement, and if you haven't received a notice or a letter from them now, and you haven't been doing this, now is a good time to start being compliant on this so you can avoid those letters later on. And I do believe, I think that's the last slide I have, but I just wanted to kind of reiterate that I think that the regulation landscape from a tax perspective is going to change. I think the focus is going to change in the upcoming years. And while you should always want to be compliant and with your tax reporting obligations, now's a really good time to kind of look internally and make sure that you are compliant with all these filings, so that there's no really expensive surprises that may come up once the IRS gets this funding.
Next, please welcome our guest speaker, Tom DeMayo, principal of PKF O'Connor Davies. He'll share his thoughts and expertise on cybersecurity and Department of Labor regulations. Tom has extensive experience with securing and managing information risk across a wide variety of industries, including commercial entities, the hospitality industry, not-for-profit organizations, employee benefit plans, governmental healthcare, private schools, and higher education. He's also a computer forensic specialist. So Tom, please take it away.
Thank you, Jim. So good afternoon, everyone. So, you know, another year, another set of cybersecurity events. And I think one of the things that, you know, we could probably all agree on is that the landscape is still moving in a negative direction. And what do I mean by that? Negative in the sense that it's getting worse, right? Between the headlines, between what may have happened to you as a business or what you see amongst your peers, you know, the cyber criminals still seem to be getting ahead, okay? Now, before we get too far into, you know, how do we kind of develop our program and how do we meet what the DOL guidance is trying to get us to do, you know, let's kind of take a step back and see a little bit how things are trending, right? I talked about how we're moving at a more negative pace, but let's kind of see how that is evolving. So on the screen, you have two really charts. One on the left is just the total number of breaches. Now, when I say breaches, you know, I'm referring to data that gets accessed in some way that it shouldn't, right? Now, as an employee benefit plan, you know, breaches are significant to you specifically because you have such a large wealth of sensitive data. So when a breach happens in the context of a benefit plan, that has tremendous impact on potentially individuals, right? It can lead to identity theft and those types of things. On the right, we have the total number of records breached in totality over all the breaches that might have occurred within that year. When we look at just the number of breaches, we have a pretty consistent pattern, right, in terms of the number. Now, maybe it's a little bit understated, right, because I'm sure a lot of organizations don't report their breaches. But 2019 was a little bit of an outlier, but we kind of stabilize again as we come into 2022 at what we typically see from a level standpoint. Now, on the right, where we look at the total number of records breached over each year, well, now you start to see a little bit of a different story, right? 2014, not too bad, and then so on and so forth. 2020, 2021, we have an explosion. 2022, we're starting to settle back down. Now, it's not really too surprising that 2020 and 2021 had such an explosion of records being compromised. If you put it into context, and you think about what that time period was. 2020 obviously was a pandemic. 2021, we were still kind of coming out of it, but there was a lot of flux. Flux in the sense that a lot of businesses had to move hybrid. People had to rapidly adapt to working remote, which means that repositories and data that wasn't historically accessible from outside the network, now it was. Mistakes were made in that hustle to get things up and running and maintaining the continuity of the business. So records got breached, right? There was unauthorized access. And again, that explosion. Good thing is that we're starting to come back down from a total number of records breached. Now, when we look at how these breaches occur, right? It's either from the outside, the external, or the inside, that internal individual, right? That trusted person that we've given access and they somehow either make a mistake or it's malicious in intent, all right? Majority of your breaches are still from the external, right? That's still from that individual outside of your organization, wherever in the world that gets access to the data in a way that they shouldn't, okay? But we can't lose sight of the internal, right? The internal threat will still persist. And, I'm sure over time it will continue to potentially get worse, right? It's not uncommon to hear now that, the cyber criminals are recruiting insiders to help get them a foothold into the network so that they can help compromise the network, all right? Now, when you look at that insider, the thing I want you to focus on, yes, you have the malicious, right? Which, again, is unfortunate. But a large portion of that is the accidental, right? That's the oops. That's the individual that made a mistake. That is where, you as an organization can get ahead of that through training, right? That's all training. That's all people. That's all process to help make sure that that accidental occurrence doesn't occur. Now, when we look at the attack techniques, right, how exactly are these cyber criminals targeting you that were resulting in these breaches or these compromises? Pretty much year over year, it becomes pretty consistent in the sense that almost 50% is going to be that phishing, right? It's going to be that social engineering. It's going to be that manipulation of you as an individual or your employees to get you to do something, right? And they know it's successful. So when you think about where you're going to put your defenses, look at this slide, right? Because it's telling you that 50% of your efforts has to be directed towards the individual, all right? And making sure that as the attackers target them, you're empowering them with really the knowledge and the awareness to not fall victim. Yes, you put in your technical controls, you try to stop what you can so that hopefully it doesn't get to them, but the employee, the person is going to play a huge part in your success or the maturity of your cyber program going forward. And then of course, other things, right? That's going to fluctuate. It's opportunistic. That's going to fluctuate over time and it's going to depend on what the period is. Ransomware to really every organization, but even to employee benefit plans is really one of the biggest risks you're going to face. Unfortunately, over the past year, I've worked with employee benefit plans. I've worked with, vendors of employee benefit plans that have been subject to ransomware, right? Now, the ransomware evolution continues to get worse, okay? Where now the demand has went from really almost up to 1.8 million on average is what they're going to request if they get into your network. The average ransom paid, we're now hovering around 812,000. Now, what's requested and what paid, you're always going to have this disparity because if you're going to be in the position where you're going to consider payment, you're going to negotiate. And typically when you negotiate, you settle for around 50% of what the initial demand was, okay? When it comes to claims frequencies, whether it's healthcare, whether it's benefit plans, that's going up dramatically. Okay. Downtime is getting worse. 6.2 days in 2018 to now 20 days in 2022. Now, in 2018, that's when ransomware kind of made its way back to the business, right? It started with individuals, then they stepped away for a while because, the crypto boom of that period, which then eventually busted. Now it's busting again, okay? But then they came back after that crypto bust in 2018 is when they started focusing on the businesses. At that time, their process wasn't as mature, wasn't as sophisticated. Over the years, they've matured that process. They've gotten better at what they do. So that when they get into the network, when they get into your environment, their goal is to get across to as many machines as possible, to get access to as many systems, to exfiltrate that data so that when they launch their attack, it's going to be pretty impacting, right? It's going to have a devastating effect, which is further going to force your hand to consider payment, all right? Without fail, in today's environment, if you get hit with ransomware, there's a good chance they've been in your network for a good 3-4 weeks prior to that attack even launching, right? Just moving, exfiltrating, doing what they do. 70% of your targets, of your victims, are the smaller entities, okay? It's the people on this call, all right? And that's going to probably continue to remain the course because in 2021 especially, there was a lot of high-profile cybersecurity ransomware attacks that brought a lot of unwanted attention to the cyber criminals, all right? To the extent that the governments of the world really perked up for a period and actively and aggressively targeted them. Now, yes, they had some success, but now they've kind of rebuilt and, relations with Russia at this point also kind of help, fuel the comeback, okay? But they don't want that attention. So by staying below the radar, by targeting the smaller entities that may not make the headlines, that's where their focus is to get the money, okay? And yes, the triple extortion threat, that's going to continue. I started first talking about the triple extortion threat last year in 2021. That's where we first started to see it. That triple extortion threat is where 1, they've encrypted your data, 2, they've taken your data, and 3, they're going to start reaching out to the individuals or the members of your plans that they've taken the data of, letting them know that they have their data and that they might well contact you, the plan provider, and say, hey, pay us because I don't want my data getting out there, all right? So again, it's all about this tactic of putting pressure so that people pay. Now, should you not pay, what's going to happen is they're going to potentially release the information, okay? You're always going to see that threat where, yes, they say they have it, and if you don't pay, they're going to post it, all right? Now, the Los Angeles School District is one of the ones that made the headlines of recent, right? Where they were impacted and they chose not to pay. And sure enough, their information was published out onto the dark web, right? So you can't consider it a bluff, right? If they say they will release, there's a good chance they're going to release, especially if they have the data. Here's what they posted from the Los Angeles Unified School District. And you can see things like passport and social security numbers. And yes, I mean, this directory is what I went to. I was able to click into passport and I was able to see passports, right? If I wanted to download those passports and commit identity theft, well, I could, all right? Once it's out there in perpetuity. If you get hit with a ransomware event, okay, it's a very predictable almost layout where 1, your systems are going to go down, you're not going to be able to access your data. And then all of a sudden, you're going to start seeing text files pop up in different locations, all right? Those text files are going to be the ransom note. And here's an example of a ransom note, okay? Each organization, this is Vice Society, that's the one that committed the assault against the Los Angeles Unified School District. They all have their own format, but in essence, it's the same thing. Hey, we've hit you. Hey, here's how we want you to contact us, and let's negotiate. Now, again, you could choose to ignore them, but then they will start to actively contact you. They will actively try to call you. They will actively try to email you to get your attention. And then if you don't, again, they'll publish the data. Now, separate from ransomware, you as a benefits plan, you have money, okay? And one of the things that we consistently see happen, and really it's the second, or really the first, when it comes to dollars made for the cyber criminals, is this funds transfer fraud. Now, again, it has a very predictable process, and I kind of love this slide because it really steps through what exactly that process is, okay? Where they're going to divert money out the door. So let's kind of step through this. So one, they identify who you are, right? Two, they try to phish you, right? So they're going to try to get your credentials. And yes, even if you have MFA, they could try to bypass that, all right? So that's not going to solve it all. Three, once they get access, okay, this is where now they're in, okay? Four, they start searching, right? They're looking for transactions. They're looking for that opportunity to inject themselves in to really a transaction, okay? So think of this as maybe one of your vendors and they've compromised your vendor, and now they're searching for transactions related to maybe you, okay? Then they start to prepare for the attack in the sense that they're going to start to email out from that mailbox. Now, before they can email out from that compromised vendor account, well, they don't want responses coming in so that the vendor sees it, because then, of course, the jig is up, okay? They need to divert it, which is where the rules come into play, so that when you respond to the email that they send, the vendor will never see it. It's going to be moved into an alternative location so that the conversation remains below the radar. 6, well, now they're going to inject and say, hey, we have modifications of payment instructions, all right? 7, you're seeing this where now they will try to get ahead of the callback. They know many of you have implemented these callback routines, but to get ahead of that, they might call you first, all right, to try to break that process with the hopes that it's just going to result in a transfer. And then, of course, money goes out the door, all right? As predictable as this is, many, many organizations continue to fall to these types of attacks, right? And maybe you have the process, but a lot of times the process isn't followed, which again results in money going out the door, which goes back to education. Now, cyber insurance. If you have cyber insurance, one of the things that you've noted, without fail, is that the cost of the premiums is skyrocketing, all right? The ability to get cyber insurance is becoming increasingly hard, all right, where they're asking you tons and tons of questions. Some are doing scans against your network, okay, to see if or not they're going to insure you, right? Back in the day when this all started, it was very easy to get an insurance policy, right? They asked a few questions and they slapped you with a policy, all right? So much so that I remember when all this first started, and I was trying to build my practice and do cybersecurity assessments and all these types of things, that there was a period where it wasn't uncommon for someone to say, well, why don't I just pay for the insurance instead of paying Tom for your services to make sure that this doesn't happen, right? They saw more value in the insurance than the actual service. Well, now the tides have shifted a little bit, right? Now it's the cost is so dramatic, and the cost of not doing something, you're not going to get cyber insurance if you don't prove that you're healthy, all right? And that's why your premiums are increasing. You're seeing sublimits, right? One of the policies that I just worked on with the companies that I VC so far, they had a 25% pretty much where the insurance company wasn't going to pay, right? So the client was going to be responsible for 75% of any ransomware event, and the insurance company would only cover 25%, all right? Which at that point you begin to say, well, what's the value? They want people to have skin in the game, all right? And I think that's important because, again, if you get the insurance company that's in the paper of recent, they're almost in the point of going under because the cyber losses have been so extreme and they can't absorb it, okay? But this goes back to why you need to be healthy. This goes back to the DOL best practices, right? And that's just that, they're best practices. To date, the DOL has labeled this guidance, right? It's not required, it's guidance. At some point, will this become mandatory? I'm sure elements of it was. Hopefully all of it does, okay? Because these are all things that you should be doing to make sure that your plan doesn't become a victim, right? That you protect your business, that you protect your members, all right? The ones that are counting on you, right? The ones that have given you your information. And how do we do that? Well, you know, the DOL has kind of laid this out, right? 1, have a cybersecurity program. 2, assess your risks. 3, third-party audits, okay? 4, make sure you have roles and responsibility. Who's going to do what, okay? And maybe you don't have someone internally that could successfully drive the program, and that's where third-party assistance comes in. That's where things like vCISO or fractional CISOs come into play. Have strong access controls, okay? Ensure that things that are in the hands of third parties you're doing your due diligence, okay? Due diligence is huge. Make sure that you're training, right? Think back to that slide, right? 50% of the efforts that a cyber criminal is going to make to compromise your network is through your people, which means you have to train. If you're going to develop, well, you need a system development lifecycle. You need resiliency. You need business continuity, disaster recovery, incident response. Okay, if the pandemic pretty much should have taught us anything, it should have taught us that we need to be resilient. Okay, and those 3 plans are going to be how we're going to be resilient. We need to encrypt what's sensitive, right? Whether it's in storage or transit, at rest, in movement, doesn't matter. Strong technical controls, and of course, you know, responding to cybersecurity incidents. This all leads to this, okay? Creating that cybersecurity program. Now, for any organization to have, you know, a fighting chance, you have to have capability and competency in each one of these 5 pillars, all right? You need to be able to identify the threats. Once you identify what the threats and the risk are, well, then you need to protect against them. Not everything is going to be stopped, which means that then you have to detect when it makes it through your protections. And then once you detect, you have to have the ability to respond. And then once you respond, you have to have the ability to recover, okay? Now, all of this is going to tie back to the DOL's best guidance, all right? Now, some of this sounds very technical, but one of the themes that I keep driving here is that it's not all about the technical. It's about the people and process as well, all right? For your cybersecurity program, for your privacy program to be effective, these 3 pillars have to come into play. You have to have the people, the process, and the technology. One by themselves is not going to solve it, right? Half of it is people and process. Technology is going to play a role, but half of it is people and process. So how do we identify? All right, let's go back. Well, 1, you need board level, senior management involvement. If you don't have that tone at the top, right, this thing that your auditors say to you all the time, right, that control environment, your program's not going to work, right? The best companies that I know have strong cybersecurity programs, it's because the tone at the top, the management buy-in is there. They understand it, they get it, they support it, and they drip it through the organization, all right? That is going to be one of the key things you have to do. You have to inventory your assets. You have to know what you have, okay? You can't protect if you don't know. That includes the hardware, the software, the data, the vendors, okay? Everything that's moving that you own, right? That could become a risk point. You have to value. You know, he who protects all protects nothing, right? I forget who says it, but it's a great saying because you can't focus on everything, right? You got to focus on what matters. In order to focus on what matters, you have to value what you have. Not all the data you have is going to be equally important. That social security numbers that you have or your members, absolutely, right? That's going to be a critical high risk value asset, okay? But maybe that marketing material, not so much, okay? Nice to protect versus have to protect. You need to do your risk assessments, all right? You're not going to have visibility unless you get effective at this process. Now, to do that, this is where third parties come into play, right? This is where organizations like myself or any other one of the companies out there to do assessments, to do vulnerability assessments, to do penetration testing, okay? All those are important. And yes, some should be at more of a frequency than others. You know, if you have a mature cybersecurity program, then pen testing should really become an annual occurrence, all right? If you're still trying to figure out where you are and how to define that program, well, the assessments and kind of building out that program is probably going to take a little bit more priority than the pen testing because you're not going to get as much value, okay? You need to identify and monitor your third parties, due diligence. You need to be aware of what's happening. You need to have the program, right? That's how you're going to protect, okay? And that's going to include that board level involvement. Policies, standards. Yes, every organization, that's the last thing on their mind, but they are important. They create accountability, they create structure, right? And they help drive what that program is. And let's face it, you know, I'm sure many of you have issued either questionnaires as part of the DOL guidance or gotten them yourselves. And one of those questions is going to be, do you have a documented cybersecurity program? Do you have policies and standards? Okay. Training, testing, employee awareness. You have to keep them apprised of the various threats, right? You have to empower them through that training. Okay. They're your biggest expense, but they're also your biggest asset when it comes to the cybersecurity battle. Access controls. Yes. Passwords, strong, long, complex, multi-factor. Now, what I don't want you to get lost in the sight of is that think that multi-factor is going to solve it all. All right. Multi-factor is actively being bypassed. However, the way they're bypassing it is through the techniques that they've always used. That's where the training is going to come into play to make sure that they don't bypass the multi-factor. So it's still going to come back to the person. Okay. You need to restrict. All right. You know, it's not uncommon for access to be a little bit too pervasive. All right. And you have to look at it. If someone got into your environment as that one person, and that one person has a lot of access to a lot of different things, well, that becomes a high risk person because, well, you know, if that ransomware gets in there, that means they can get to that data. That means they could exfiltrate that data. All right. So you want to think of it in that perspective and not just say, well, everyone needs access to everything. All right. You got to restrict those admins, maybe those managed service providers that you work with. You have to control their accounts as well. Right. Because look, us as pen testers, us or cyber criminals, if they get into your network, right, they get into your environment, they're going to be seeking out those admin accounts. Why? Because they know that once they get them, they own it all. All right. And at that point, it's game over. You need to make sure that when you're thinking about how your environment is architected, that if that cyber criminal gets to that one machine on your network, right, because they compromise that one employee, that you've architected and put in the control so that that cyber criminal can't really pivot left or right very easily, right? They don't have that lateral movement, that spread that the cyber criminals are trying to get, right? Remember what I talked about with the ransomware? They get in, they're going to try to compromise other machines. That is part of lateral movement. You need to encrypt, right? Making sure that the data is protected at rest and in transit. You need effective malware solutions, right? Regular AV is dead. You know, if you go back to your IT folks, make sure that you hear the word that they're using EDR or XDR, okay? That is where you need to be today to have a fighting chance against all the sophisticated malware that is out there. You need to patch, right? Look, vendors come up and they say, look, we know there's a security problem. Here's the fix. If you don't apply that fix, I can guarantee you the cyber criminals are going to take advantage of the fact that you didn't apply that fix. And yes, the fixes come out pretty consistently, which means that you as an organization have to have the resources to consistently patch and make sure that you don't become a victim as a result of that vulnerability. Zero trust, very much a marketing term, but it goes down to making sure that anytime you're going to let somebody access something, you know who they are, you know what machine they're coming from, and at the end of the day, they're only going to access what they need to access. All right. Those three pillars have to come together to create what they call zero trust. You need visibility, right? You need these types of tools so that, you know, all that information that's being collected across the systems from who's accessing what is being fed into something that can try to make sense of it. So they can alert the IT folks that something is going wrong that a person alone is not going to identify, all right? That's the tool set. You need the logs, all right? Your system captures activity. If an incident occurs, those forensics guys that come knocking, they're going to want to know if you have logs, right? Because that's going to help them identify what potentially happened. And if you don't have it, it puts you at a disadvantage. You need to detect, right? You need to alert. When things come up and happen, well, someone has to respond. And this is where third parties can come into play, where, again, maybe you don't have the resources to have a full-blown 24/7 team internally that's monitoring alerts, but there's services out there that will facilitate that. And you get economies of scale, right? They're called SOC as a service. You need your incident response plan, right? Your policy, your plan, your playbook. You need to think about testing that plan, tabletop exercises, getting everyone into the room and just going through scenarios and seeing if people understand what their roles are and how you're going to respond. And look, you know, even a ransomware event could result in a business continuity event if all your systems are down, all right? This is where backup and making sure that your backup is ransomware resilient is going to be critical, okay? Because if they could find a path to your backups, which they're going to look for, and they could take those backups offline or delete them or destroy them or encrypt them, they're going to. In which case, then your only option of recovery is going to be likely having to pay, okay? And again, you need the plan. You need recovery metrics, all right? You know, too often, you know, the whole cybersecurity, the business continuity, it's siloed with IT. But we have to look at this. This cybersecurity issue, this is not an IT issue. It is a business issue that requires the assistance of a technical solution, all right? But the business owns the problem, not IT. The business has to set the grounds. The business has to set the metrics. Otherwise, what's going to happen is IT is going to do things and it's going to be misaligned with what the expectations are, or even what the needs of the business are, right? IT is not always going to know the criticality of everything. That's a business decision, all right? Guide them, okay? And if you're not sure how to do that, again, that's where consulting and those types of things come into play. I am kind of running out of time, but very quickly, and again, you'll have these slides, you know, incident response, okay? This goes back to the plan. It is important that you have a plan, and what I've kind of laid out here is how do you think about constructing this plan, right? Who's going to be a part of it? Again, not just IT. It should be your certain members of your executive team, your HR, your legal, marketing, okay? Because when an event occurs, it becomes just as much as a public relations event than anything. All right, because people are going to be watching how you respond, and how you respond is going to be the difference between, you know, a positive outcome or the most positive that it can be versus a critical backlash from authorities, regulators, from your customers, right, from your members. That plan should have technical components, right? Who to call, right? Calling trees. When do you loop in cyber insurance, right? Is it a covered event, right? You don't want to overstep too far in that loop insurance because then they might not pay. How are you going to safely communicate? If you get breached, all right, depending on the incident, there's going to be a period of time where you're not going to be sure if your email system is safe to communicate, which means that as part of your plan, you have to have alternative modes of communication, burner email addresses or other email addresses, cell phone numbers, those types of things. Those are all going to be important, okay? And with that being said, thank you very much.
Okay, thank you, Tom. Our final speaker today is Joe Hershin, an audit partner here at Calibre. He'll be giving important insights on the Department of Labor audits and best practices for employee benefit plans. Joe specializes in providing auditing and consulting services for labor organizations and all types of Taft-Hartley funds. These plans range from local to national, both single and multi-employer plans. And he's represented and guided various plans and labor organizations under review by the DOL and the Internal Revenue Service as well. So welcome, Joe.
Thank you, Jim. Appreciate the introduction. Looks like I'm batting cleanup on presenters here, so I'll try to present a lot of information here, both the Department of Labor and employee benefit summaries, fairly succinctly, but quickly as well. If we move on to, how do I move the slides? We're controlling Nadine's screen. All right, good enough. Goals and objectives, of course, Department of Labor, we're talking about enforcement. Department of Labor, of course, our goals and objectives throughout the slides here discuss identifying best practices during a DOL audit, sharing relevant experiences, and also explain some key takeaways. The DOL audit process begins pursuant to certain ERISA code sections, ERISA 504 and 506. 504 is very important because it's part of Title I of ERISA, which I won't go into, but a lot of details there. If we move on to the summary makeup of the DOL audit process, the Enforcement Agency Office has over 300 trained investigators and regional offices throughout the country, of course. If there is a civil litigation, it's referred to the Office of Solicitor. This slide here is pretty interesting. This is for fiscal year ending 21, September 30th, 2021. So just about a year ago. Department of Labor is summarizing their monetary recoveries for the fiscal year ending. Total dollar amounts recovered through enforcement, 2.4 billion, pretty sizable amount. Recovery from enforcement actions, 1.9 billion. And then your voluntary fiduciary correction program, that's where fiduciaries step forward and voluntarily comply. The next column, abandoned program plan programs. Interestingly enough, there are a lot of programs out there, mostly 401k plans, single employer plans, that are simply abandoned by bankrupt employers, other employers that have merged. The monies are just sitting with the record keeper or the bank or whomever. No trustees exist. There's a process that Department of Labor requires the plan to go through. Part of the issue is if there are no contributions or distributions in a 12-month period, the Department of Labor potentially considers that plan abandoned. So even with that said, you can see almost $51 million in recovered under abandoned plans. There is somebody called a Qualified Termination Administrator, a QTA, that has to be engaged to handle the abandoned programs. And then the far right-hand column, monetary benefit recoveries from complaints, 400 and almost 500 million. The next table simply summarizes, looks like a 12-year period, 10-year period, sorry. As you can see, the metrics changed in 2015, more to a recoveries from enforcement action, 16 going forward up to 2021. The dollars in column 2 fluctuate fairly sizably or wildly, but based on enforcement action and compliance recovery. So no rhyme or reason to that. As we look at the certain types of investigations that occur with the Department of Labor, of course, there are compliance. That's number 1. Fiduciary duty. Number 2, prohibited transaction. And not most, but hardly any at all, but criminal investigations as well. Department of Labor generally does not identify to the plan sponsor the reason for investigating, unless it is criminal. So with that said, here's a summary of inquiries made in 2021. You can see 175,000, almost 176. The thing to notice here is on the bottom of the slide going 13 upward. The inquiries have gone down, which means there is much better education, much more education to trustees and plan administrators on what to do properly for the funds and less inquiries being made. So that's good news. The monetary benefit recovery from the complaints, 499.5. Open investigative inquiries, 251. The things that trigger a DOL audit, participant complaints, about 25% of that accounts for it. Missing participants, we'll go over that later in my presentation here. Those are mainly on K plans. IRS coordination on the right-hand side, 5,500 compliance questions. The next to last bullet on the right-hand side, service provider review. That's audits of us, the plan auditor. We have occasionally gotten those inquiry letters through our clients and have to comply very quickly. And then there are random call-in explanation and inquiries as well. Oops, going too fast. Yep, common findings, no fidelity bond. Of course, bullet number 3, expense reimbursements. First class air, alcohol, they're all no-nos. Can't do it, not on an ERISA fund. Lack of documented policies and procedures and late participant contributions. The things that they look to the trustees for, at least for their fiduciary responsibility, is whether they can take physical possession of assets, certain power transfer of plan assets, meaning do they have the intent and power to do that within the investment portfolio. I was trying to think about physical possession of plan assets, something that's come up at least on some of the employee benefit plans that I audit. The trustees are provided with iPads to attend electronic the documents, to read them while they're in the board meetings. On my plans, at least the fund administrator takes back the iPads and does keep possession of those within the fund office. They do not allow the trustees to have those for personal use. We have a DOL audit life cycle. The DOL selects their plans, they follow up documents, and then they have their final steps. The process talks about an appointment. You should appoint a point person, someone who's just filtering all the questions and all the process and all the documents. Attached below this slide here indicates what an initiation letter looks like. It's always written to the plan sponsor, addressed to them. It'll indicate the number of working days that we have to respond and some of the inquiry and some of the data that they would like to see the plan documents. 20 days goes a lot quicker than you think, especially when you're trying to fulfill all the data that they may request. A subpoena that may come if there's a criminal investigation. The initiation letter usually has standard request items, such as plan trust documents, policies, SPD, meeting minutes, and bullet number 5, the form 5500. One thing about the meeting minutes that I've noticed as an auditor, the meeting minutes aren't always kept timely. Just about when I'm performing audits, if I'm asking for subsequent minutes, the minutes are being written the day before the upcoming board meeting. So plan administrators out there maybe try to do the meeting minute summaries more timely while the information is fresh in your mind. That would be great. The timing can be short. Of course, the Department of Labor wants what they want when they want it, or it can be long. And then the last item there talks about a tolling agreement. The word tolling just means that they can change or at least extend the statute of limitations on certain documents and certain subpoena power items that are documents that they would like to see. The timing of the initial audit, I underlined the top slide at the top bullet. Do not interpret a gap in time as a clean bill of health. The Department of Labor moves at their own pace. They will do what they do, and you just have to sit tight and respond timely when they request. Self-audit, that's always a good process to go through in trying to avoid any hiccups while you're under audit or under inquiry. We also, in the third bullet there, talk about inquire of your fund counsel, actuary auditor, investment consultants, whether they are also in compliance with the DOL guidance on documentation. The Department of Labor will probably, on an inquiry, try to interview 1 or 2 trustees. An attorney may be present, but they have a very limited role. They just want to discuss things with the trustee to get an overall knowledge of the plan, their knowledge of the investments, the portfolios that they're invested in. Best practices right here, summarized. You can go yourselves into the checklist that's enumerated on bullet number 3. And, the best practice is always to treat it like a deposition. Only respond to questions, don't volunteer information and say, I don't know, or I don't recall. That's fine, as long as it's true. Has to be a true statement. Have all your all your documents organized, of course. That's goes without saying. The investigator will eventually compile findings. They'll give you a timing range. General types of letters that you'll see: no violation letter, a 10-day voluntary compliance letter, and a referral letter. Referral letter is not good. No violation letter, case closed, alerts the plan fiduciary carrier if a notice had been previously sent. And that talks to your insurance, fiduciary bonding, fiduciary insurance. When this process or inquiry occurs, the plan probably should at least notify your fiduciary carrier that there is an inquiry ongoing. It doesn't prompt them to make a claim at all. There is no claim, just let them know. Of course, we have the 10-day voluntary compliance letter. This can impose 20% penalties and on the second bullet there, which are pretty steep. It talks about excise tax due to the IRS. We know that that's pursuant to certain filings, Form 990T and such. We do have a polling question that just popped. Okay, great. So in general, the proposed correction may take a long time. It might discuss removing a fiduciary, which is a trustee. In most cases, it can be other fiduciaries on the trust as well. So I have to answer it as well. All right, got it. All right, my slides are now moving again. Got it. Let's see, moving on, penalties and assessments. Exchanging correspondence. The third bullet's important because it talks about exchanging correspondence with the DOL. Don't discuss it too freely or discuss certain things because they may take it as a position of settlement under 502I and discussion of penalty. If the plan corrects a prohibited transaction, excise tax may be due to the IRS. We discussed that just a few slides ago. And then the fiduciary insurance needs to pay any excise tax, cannot be paid out of plan assets. The employee benefit plan cannot pay the excise tax for fiduciary breach. Conducting a self-audit, of course, this is common sense. Hire the right professionals, your attorney, your auditor, your investment consultant, actuary, and administrator, of course. You should also make sure all fund documents are updated. Review all policy and procedures every 3 years. Are there any updated written investments, policies, collection policies, written expense policies? Written expense policies are very important, especially for the ones that cover the trustees or the fiduciaries. For instance, travel, which is number 2. The discussion of coach versus first class air, alcohol, the exclusion of those items should be clear in the policy. If there's any updated retention policy, we've all seen that question, at least the auditors have on Form 990. Of course, conducting a self-audit, we also talk about health fund compliance, many stipulations here under HIPAA. As you can see, the third bullet provides you with a link to the site for any checklist, self-compliance checklist, which is very good. The last thing is under Department of Labor, they also have programs where you can come forward yourself and voluntarily correct yourselves or your program, your lack of filings. Number 1 talks about the voluntary fiduciary correction program. This allows plan officials who have identified specific violations of ERISA to take corrective action, more or less discussion of prohibited transactions. I won't get into that in detail. However, that is with fiduciary violations. Number 2 is much more frequent. The delinquent filer voluntary compliance program. It's a mouthful. DFVCP encourages plan administrators. Those are the filers of the 5500s to bring their plans into compliance with ERISA requirements. So as you can see in bullet 3 and snapshotted in the table below, the EBSA received 22,553 annual reports for this program in 2021. That's a very sizable amount voluntarily coming forward and either filing their first 5,500 because they were not in compliance or correcting a deficiency within a 5,500 that they filed. That's very good because it's better for you to voluntarily report an issue than for them to find you. If they find you, the compliance issues and penalties can be extremely stiff. Moving into the second part of this discussion, We have best practices, key areas within employee benefit plans. I've summarized a few terms here. Of course, areas specific to multi-employer plans are payroll compliance audits, actuarial evaluations, and hard to value assets. Going too fast. All right, this is an important slide because I'm assuming a lot of the participants, at least plan administrators as well, have to deal with providing data to auditors and such to perform payroll audits. The new Chapter 9 in the audit and accounting guide for the employee benefit plan released in October of 2021 discusses a nuance within the requirement for, or at least the process in performing payroll audits. The assessing the time period covered by the payroll audit compliance function. We can see that the plan auditor now must determine whether sufficient testing has been performed for the current period under audit. So think about it. That means, and this is more from an auditor's perspective, and plan administrators may be wondering, why are they now moving the time up? We used to do it 3 years prior. And then all of a sudden we're talking about testing plan data for 2021 in 2022, early to mid 2022. Well, that's exactly what Calibre did. We met early in the year, discussed this new requirement or discussion point here, at least determining whether we had sufficient testing for the current year under audit. It was a change. It ruffled some feathers, but the bottom line is that we applied it to all of our multi-employer plans, and it was successful. And I think everybody that cooperated with us on the administrative side, the fund administrators, provided us what we needed in a timely manner to complete our audit. And also it has an effect on the audit, the documentation of participant data testing, which we have to document in our audit file to keep things moving forward and to pass peer review. So very good that that process was taken into account early. The payroll audits, of course, there are required by multi-employer plans. We all know there are participant information outlined in the 6 bullets there. The goal is to figure out or to determine all participants covered by the CBA are being covered. The contributions, of course, can be based on hours, other criteria, whether or not the proper rates are being paid, and then also that the contributions cease when they should cease, meaning end. So there starts and stops within the data. The auditor will test that as well. Discussing hard to value assets, of course, the fund office and the trustees should document plans management trustees processes and internal controls related to the valuation. So trustees surround themselves with professionals. They have investment consultants, investment managers, investment custodians. All of those professionals should have agreements on file that document what they do for the trust and if they have fiduciary coverage on the trust as well. Some investment consultants are fiduciaries, so be aware of that. Bullet number 2 talks about the SOC 1 internal control reporting. We as auditors do rely on that for part of our audit testing and documentation as well, so that's very important. Third bullet speaks to obtain all investment managers supporting documentation for real estate investments, limited partnerships, ownership interest. And the last parentheses there, K1's potential UBIT. I'm sure that some of the larger funds are quite well aware that some of the limited partnerships can spin off something called the UBIT process, the UBIT tax, which can be sizable. The regulation of trust fund expenses, 402 requires a plan to specify which payments are made to and from the plan. This is a normal course of business issue. 404 talks to the fiduciaries to administer, which ultimately the fiduciaries are defined as the trustees. So just be aware of that, and reasonable expenses of the plan as indicated at the tail end of that sentence. Prohibited transactions, won't get into this too much, but ERISA 406 discusses a fiduciary with respect to a plan shall not deal with the assets of the plan in his own interest. So they cannot be self-dealing. Some comments or some summaries of fiduciaries look to these 6 bullets that are 5 bullets that discuss that a fiduciary has to act solely on the interest of the plan. They have to carry out the duties prudently. They have to follow plan documents. They have to diversify plan investments. And they, of course, have to pay reasonable expenses. Diversifying investments, just touching base on that. I had a trust fund several years back when the market was going crazy, up. They stayed conservatively invested in CDs, earning nothing. Some of the plan participants and the attorney brought action against the trustees for not diversifying investments. So think about it. You have to be on both sides, the good side and the bad side, meaning if you're missing leverage on investment earnings, that's also not good. Prohibited transactions, exceptions for necessary services. Of course, that's actually incurred. And then potential consequences for breach. There could be personal liability, restoration of loss to the plan, or potential penalties of 20% from the DOL. And hope not, but hope there are no criminal penalties. Withdrawal liability, just wanted to touch on this as a key term. What is withdrawal liability? It's the employer's liability to a multi-employer plan as the result of a complete or partial withdrawal. So there's a liability assessed if there's an unfunded vested benefit. These assessments are performed and calculated by actuaries and provided to the employer for their obligation. Some of the background, the history for the period 1945 through 65, multi-employer or back then Taft-Hartley plans were established by unions and employers to provide benefits to employees represented by unions, of course. The bullet number 1 talks about the CBA set rates subject to approval of plan trustees. However, in that time frame, that early stage, employers could withdraw without penalty. So there's been a huge change in the process. Another polling question popped. Didn't realize I had to answer them. Okay, withdrawal liability. Of course, 1980, the MPPAA Act discusses that an employer who ceased to contribute could be required to pay its proportionate share of the plan's unfunded liability, which means future liability, even if the employer had fully paid contributions required under the CBA. So this means if you're an employer, you better be aware that when you're joining a multi-employer plan, you have an obligation that extends way past your current obligation to pay current employer remittances through the date of discussion of exit. These assessments tend to be in the millions of dollars. A mass withdrawal, it's quite unique, although I've seen a few with a few of my clients recently, where all of, as it says next to number 1, all employers withdraw or cease to be obligated to contribute, and substantially all pursuant to their agreements stop funding the plan. Liabilities for employers withdrawing within the plan year in which they will be calculated without applying the de minimis reduction. So if you withdraw and you're an employer, a single employer withdrawing amongst hundreds of employers, they will apply, meaning the actuary will apply a de minimis reduction of the 20-year cap. If everybody withdraws in a smaller plan from a defined benefit pension plan, that de minimis reduction is removed. Missing participants and timing of contributions. I did touch on that in the beginning of the slideshow. We talked about this as one of the highlights. The Department of Labor has implemented a program for plans discussing or at least searching for missing participants. As you can see in the first bullet there, the DOL reviewing 5500s auditing those with a high number of, to keep this in mind, deferred vested. So when you're looking at page 2 of your Form 5500, question 6, there's a line for deferred vested participants. If you look at that and it's fluctuating upward fairly substantially each year, that could be a cue for the Department of Labor to at least send out an inquiry and maybe discuss with you some missing participant tracking and tracing. Plans must show, of course, as pointed out here, that they've taken steps to locate the participant, which can be very onerous. So we want to keep at least a good database and process in place to be able to trace potential participants and be in touch with them. Of course, there's certified mail bullet number 2. You can use a search method, a locator service, a credit reporting agency, or other proprietary internet search tools. With that said, you just can't keep on doing what you've been doing. They're out there, they're looking for missing participants. And let me back up a minute. The part of the issue here is these are all defined contribution plans. I was segueing a little bit abruptly there from defined benefit plans into a defined contribution plan, which are more like your multi-employer 401k plans, where there's participant contribution as well as employer participation and contributions. The plan needs to document all efforts to find. And the last bullet is one thing that I've been on both sides, both plans, both the defined benefit and defined contribution, asking to see, or at least filter through on the audit side, a letter being sent to the participant when they hit age 72, because there is a required minimum distribution that has to occur, and they want you to, the fund office, to be able to indicate that they have sent the letter out and they have notified. And I believe Jeff Lewis alluded to the fact that that age may be increasing. It's not been written into law yet, but it may be increasing by 2 years. Further timing of participant contributions, of course. The meat of the order is the 3 bullets at the bottom. The general rule is set forth in 29 CFR. Employees must deferred the earliest date that they can reasonably segregate from the employer general assets. So if you remit your payroll withholdings 3 banking days after and paying your FICA, Medicare, federal withholding, such, then you should reasonably segregate your K plan employee deferrals and that same methodology. However, bullet number 2 speaks to the 15th day. I think everybody in the audience is aware of that. It's not written in stone, but that seems to be the outlier that once you get past that 15 business day, you have an issue with a late contribution. Smaller plans, of course, less than 100, you have a safe harbor of 7 business days, which is tighter yet. Possible prohibited transactions for late contributions, of course. Deposit, I just handled bullet number 3 here with the client as of this morning, as a matter of fact. Late remittances on Schedule H, line 4A, schedule of delinquent participant contributions. We are looking at summarizing the principal amount due. So if Joe Harrison had $100 withdrawn, it was remitted late, that would be itemized by the employer name with $100 in a schedule. The schedule of delinquent participant contributions, please understand that's the amount withheld that was late. The employer themselves has an obligation to correct that with the Department of Labor by also filing and submitting the foregone interest that would have been earned had it been invested timely. So be aware that the plan itself, the multi-employer plan itself, is not obligated to do any of the interest. They are just obligated to report the principal of the withholding that was late, but the employers need to be aware that they are responsible for perfecting the contribution, including interest due. Key takeaways just about at the end here. I'm finishing up a little early. Of course, we should conduct self-audit, educate trustees on compliance issues, correct any identified issues as they are detected under audit, update your policies and procedures, review fiduciary liability insurance, and most of all, create a strong defensible fiduciary record during decision making. So document the process. And as long as it's documented, at least you have something to discuss on inquiry. If it's not documented, you might have more of a discussion point with the Department of Labor on inquiry. So I believe I'm up early. There's the last of the polling questions. All right, so with that, appreciate everybody's time, and I believe I'm complete with my presentation, Jim.
Great. Thank you very much, Joe. And thank you to all of our speakers. Now let's move into our Q&A session. And it looks like we've got about 7 questions. So I'll go ahead and pull a question, and any one of our speakers, please feel free to respond. Let me take a look at those. So the first question, how often should a company have a cybersecurity assessment and penetration test performed?
Sure. So I think it's going to go back to your maturity in your process. You know, if you've done the assessments, you know, you feel comfortable that you've gotten rid of all the low-hanging fruit, and you know you're comfortable that you have the ability to detect, then you know the penetration testing should become an annual process, right? Just to make sure that there aren't holes or gaps and that the tools are responding the way they should. From an assessment standpoint, audit standpoint, you know, again, depending on your size, your resources, I would say 1 to 2 years.
Great. Okay. Thanks, Tom. The second question looks like it's tax related. If you have never filed an unclaimed property return in DC, when do I start filing?
Yeah, thanks, Jim. So DC specifically, one of the things with the states, every unclaimed property report, or every state has different rules. With DC, just so everyone knows, that it's not a calendar year filing. It is a July 1st to June 30th filing, and the due date is, while we're past it now, is November 1st. And there's also extensions available, but they're not automatic extensions. It's something where you actually have to ask for the extension. You send it to DC, and they would approve it based on the facts and circumstances. In looking at your organization, if you think you have if you haven't filed, and like I mentioned, DC has the negative reporting requirement, I would look and see what type of assets qualify that have not been reported. And it's important because DC does, there's a penalty that could be assessed, but also DC and many of the other states have what's called a voluntary disclosure program. And if it's something that's substantial enough, you may want to, before filing an older, a dated return, you may want to go ahead and apply under that program, because it would keep you, there's a safe haven from penalty. But the one caveat is you can't be, once you're notified by DC that you are, you have not been compliant, or they think you haven't been compliant in these filings, you're no longer eligible for that. So what I would do is I would assess the situation. Generally speaking, it is about a 10-year look back. So it really does determine on the facts and what type of liability of an unclaimed property is there.
Great, thanks, Jeff. Next, looks like this is relating to some of the accounting updates we heard earlier. Does Calibre have any resources for helping to determine the new lease liability and right of use asset?
Sure. So we have one of our partners put together a really nice Excel workbook with several tabs in it. You can kind of plug in all the data points from the lease, and it will, it has a way to tap into kind of the internet to get an update on the risk-free rate of return to help you with that calculation. And then it'll put the calculations together for you. So we can, if you're interested in seeing that, we can get that out to you.
Okay, great. The next question looks like it relates to employer payroll compliance audits. Why do payroll auditors ask for the entire employer payroll and not just the participating union collectively bargained employees in the requested audit inquiry letter?
Jim, I'll take that. That's a very good question. I get nailed with that all the time. When we go into the field to do payroll audits, and some of the discussions pass through the fund office as well. So the administrative office settles that as well, but in discussion. The process on a payroll audit is we as auditors have to reconcile the gross payroll to IRS filings to make sure that we're looking at the entire payroll. The bigger issue coming out of this is potential unreported employees, which have not been reported pursuant to our CBA. So if we're testing on behalf of laborers or carpenters, whomever the trade is, there's potential issues out there where a person may be missing when they should be reported pursuant to the CBA. So we have to at least review that, check that with the local union to make sure that the person that they may determine they are on the roster and they are part of our local and they should be reported on. So the first question was, why do we need everybody? We need everybody to feel comfortable that we're doing a complete audit. A second, to review everything to make sure that we are not missing any unreported employees on behalf of our process for the trade that we are auditing on behalf of.
Got it. Great. Thanks, Joe. Looks like another tax question. Is there penalty relief available if we find out that we have failed to include any of the international returns for previous year's tax filings? And how many years would we need to go back?
So there was IRS just issued a relief for tax years 2019 and 2020, which would have been filed in 20 and 21. Penalty relief for any failure to file, and it was all encompassing, but it also included these foreign filings. Unfortunately, that expired. It was the end of September. I think it was September 30th. There's been some dialogue that maybe they will push that for one more year. But again, it's specific just to those years. So if something was missed for the 2021 year, filed in 2022, there's hopes that they're going to continue that process. Now, for returns older than that, IRS usually follows what's called statute of limitations. Statute of limitations for a filed return is usually 3 years, and there are some exceptions to that. However, for a return that's not filed, the statute never really starts. General guidance is you go back 6 years if you find that you've been non-compliant for 6 years. To do that, other than the current guidance, I'm not aware of any voluntary disclosure program that's available for IRS purposes, but that's really what we're looking at, is probably 6 years to be fully compliant.
Got it. Thanks, Jeff. Jeff, while you're talking, one other question just popped up before I get to the other ones, but it's tax related. So let me ask that now. If a multi-employer plan pays benefits in several different states, must they adhere to the unclaimed property laws in all of those different states?
So that's a good question. And so the one thing that there is communication between the states. So if you're a DC fund office and you have recipients that are on your unclaimed property list, and it covers all those different states, my understanding is that once it's submitted to DC will then communicate with the other states. But the general guidance is if you're aware that the individual is currently in another state, you can be more proactive and communicate it directly to that state under their unclaimed property rules. There's also there is a federal kind of general guidance on unclaimed property, and a lot of the states do adhere to that. One of the differences, like I mentioned earlier, is most states will take a calendar year and use that as a basis for when you need to report it. DC and a handful of other ones use different, July 1st to June 30th. So there could be some issues just with timing. And then some states are a little more stringent on what they determine to be a qualified unclaimed property asset. General guidance is on payroll related matters or pension related matters. It's usually a 1 year. On other ones, it's 3 years, but it does vary from state to state. But there is just the important thing is that there is communication between the states. If they think that if they're holding an asset that is in the jurisdiction of another state.
Great, thank you, Jeff.
And Jim, can I just add one more thing on the earlier question on disclosure or voluntary disclosure and free from penalty? The one, if you were to go back and file something, there is a reasonable cause basis for penalty abatement. With the IRS, there's never a guarantee under reasonable cause. With the voluntary disclosure program, there is guarantee. But for the most part, what we've seen recently is the IRS is making an effort not to penalize somebody who's trying to file the right thing. And again, this is not a tax abatement, especially with the foreign filings. It's more of an information return. So you haven't really benefited any. So sometimes there's a lot of leniency with the IRS saying it's more important for us to get you compliant than to penalize you and kind of create this atmosphere where people are scared to get compliant.
Great, thanks. The next question looks like it relates to payroll audits also. I think you probably addressed this. Is there anything in the October guidance, October from last year, 21 guidance regarding AUP versus consulting arrangements for payroll compliance audits? So I'll address that. AUP stands for Agreed Upon Procedures, which is a type of engagement that auditors perform. It was not addressed in the 2021 revised guidance, but I know it is acceptable to structure the payroll audit engagements either way. They could be an agreed upon procedures, which is a little bit more stringent as far as the procedures that are performed, or it can be structured in a consulting arrangement as well. And then the last question that we have, you mentioned CISO. Can you elaborate more on what that is?
Sure. So, VCISO, think of it as, fractional or part-time. A lot of organizations, based on their size, resources, can't justify a full-time VCISO. So a full-time CISO. So the virtual CISO kind of helps accommodate that on a part-time basis, but still provide the expertise and the structure and the strategy to really develop and drive that program.
Got it. Thanks, Tom. Okay, well, this wraps up our conference for today. We want to thank you for attending and hope you found the conference helpful and informative. You will receive an email with instructions on accessing the program materials that we saw today, and also requesting the 2.5 credits of continuing professional education. We look forward to seeing you again at our next conference, and have a great afternoon, everyone. Take care.